Imbalance is a concept which tells you where the market is likely to go. We can use the concept of imbalance in any strategy to give us a better picture of where the market is likely to go, increase our win rate, or even just add an extra confluence to our trading. So if you're coming to this video, I'm sure you've heard about smart money concept or ICT. This is an ICT concept, a smart money concept. But I was taught it about 3 years ago from a trading course who was teaching smart money concepts. He learned it from a South African guy, but again, ICT is the creator of the concept. He learned it from a South African guy and was teaching it to us, posting 1 to 100s every couple of days, making us think, oh my god, you can make stupid money with this. If I get a 600k funded account, I can make 600k in a week. And like everyone in this course was kind of brainwashed for a long time. I was brainwashed for like a year. And in the end, I realized he's just a course seller. He's not even a profitable trader. This guy is just a complete fraud. But I did learn a lot of concepts from this, and I do use these concepts in my current trading. Now, I don't trade smart money concepts like majority of people. I literally trade a 1-to-1 strategy or a 1 to 1.75 at max. So I trade a very different strategy, but I still use all these concepts in my strategy. So even if you just trade a trendline strategy, using imbalance can massively increase your win rate or even just give you extra confluences. So I'm just going to get right into showing you where the imbalance is in this impulsive move. So what we need is 3 closed candles. So this one has closed, this one has closed, and this one has closed. We know this hasn't closed yet as a new candle hasn't opened up. So as we can use this one and this one and this one, we can find the imbalance for this candle and anything behind. To even spot the imbalance, what you need to do is look at your middle candle, and it would be the previous candle high on an uptrend. So from this candle, draw a line to the right, and then the next candle low. So the zone between these two is the imbalance for this candle. So within this candle, we actually have pure buying from here to here based off of this time frame. Obviously on the lower time frame, there are sells being put in here, but based off the current 1 hour that we're looking at, there is pure imbalance from this high to this low, as it's just pure buying. Essentially what this means is the market isn't balanced as the sellers haven't brought it back down to refill this zone. Now, if this candle wick was down here, the imbalance would be this zone here. It would just be this little bit from here to right here. And now, if the wick was like this, where they're at least equal to each other, there is no imbalance in this candle, as it would be no pure buying. What this means is right here, the buyers push price up and the sellers brought it back down. Buyers push price up, and then again the sellers push price back down to refill the pure buying. So price would have already balanced itself out. Whereas when we're like this, the sellers haven't rebalanced the market by pushing the market back down yet. Now if we come and look to the left, obviously it looks like buying, buying, buying. It looks like the buyers are winning, which they are, but the sellers are also keeping it balanced out. Even though the buyers are winning, the market is still balanced. And when I say balanced, I don't mean the sellers and buyers are putting an equal amount of orders, because that would just send the market sideways. What I mean is the sellers are coming back and refilling the imbalance. So they are balancing out of the imbalance zones. So essentially, if we look at this candle here, if we go to the high to the left of it, to the wick to the right of it, there is no imbalance in this zone. The high and the low have already balanced itself out. Again, if this low was here, we would have an imbalance zone from this high to this low. Pure buying in this zone, meaning sellers haven't pushed price back down to rebalance this zone. But again, this isn't the case. The case is that they are equal. Now if we look at this one, from the high to the low, remember we're always looking at the middle candle. So this tiny bit of imbalance would be for this candle. So this candle does have a tiny bit of imbalance, and again, when we have imbalance, we expect price in the future to come down and refill the imbalance. So as we can see, we actually did see price come back down and refill that imbalance. But yeah, let's keep on moving. We're going to look at this candle now. The high to the left. And again, we already know the wick to the right has come all the way down and refilled the imbalance that was created at the time, so there is no imbalance. So to keep it simple, imbalance is essentially where the buyers or sellers completely overtake the opposite team. So in this buyer side, the buyers have completely overthrown the sellers, making the move so impulsive that the sellers can't even push price down to balance this out, leaving behind imbalance. So we have imbalance from here to here, and when we have imbalance, it does need to be balanced out, or it usually gets balanced out. I mean, majority of the time it will get balanced out, so it is an area we're expecting price to go back to in the future. And with this concept, essentially what it is large money movers such as banks placing these large orders. That is the concept behind this. Banks are placing massive orders where sellers cannot even compete with it. So like banks are buying here, and then the sellers cannot even bring it back down because it's the banks with these big money positions. And I'm not saying this is the truth, but this is the concept created behind it. And I don't want to go too far into ICT concepts because this is a video on imbalance, but we also have the concept of mitigation where banks will place these large orders, but as banks don't just close out their positions, they hedge their positions. They will place all these large buys, but they will still have sells. So what they need to do is bring price back down in the future to close out their sells. So as we're having a big move like this, we think, okay, this is the banks placing these positions and they still have sells down here. They have imbalance here. So price will come back down to refill the imbalance, close out their positions and continue on the way. So that is kind of the concept behind it. Now, how do I use it in my strategy? So with my strategy, I'm looking for a clean trend. We have a clean trend. And then I'm looking for an impulsive move, which we can consider banks placing large positions. So we have the impulsive move. We also need the order block. So the order block is the last sell before the buy. So this is the last candle before the banks place their last positions. So this is the last sell before the buy. So that would be the order block. And then the order block needs direct imbalance at it, which it does have. We have direct imbalance right there. So now in our head, what this means is, okay, there are still sell positions here by the bank, and there is imbalance here which needs to be filled. So what's going to eventually happen is price will come back down, refill the imbalance, close out the bank's positions, and then continue on the direction. So that is essentially how I trade imbalance. Now you could trade imbalance in a completely different way. You could just connect it to your strategy, but that is my entire strategy, and that's how I use imbalance with my strategy. And I'm going to flip the chart just to show you an example in the sell. Imagine the green candles are sell and the red candles are buy. We would look at the low of the previous candle and the high of the next candle in a sell situation. So this would be the imbalance zone. Oh, I can't drag it. There you go. That would be the imbalance zone. So it's the exact same, it's just the opposite way around. Now I'm going to show you this example for a trade I actually took. We can see we're on a nice uptrend, so we already have trend identified. And I'm going to show you the trade on the right, if I just delete these. What we had was a very impulsive move. We had the order block right here and direct imbalance. So if I mark out my order block, this was the order block. I did refine it to a lower time frame. I actually broke down this trade in detail. And then we have clear imbalance from here to here. Okay, so we have a large position being placed. We have imbalance, so price should need to come back down, fill it in, enter us on the order block, and then we continue on with trend. This was my setup. This is how I trade. Very simple. So we're going to just mark out some more imbalance so you guys can get the hang of it a bit more. I'm going to start down here. So we have the imbalance zone from here to here. You can see there's a tiny bit of imbalance. And remember, imbalance will vary on time frames. So for example, if we go to a lower time frame, these imbalance zones might be different. Let's go down to the 1 hour, and they most likely will be different. There you go, exactly. So now we have a 1 hour imbalance from here to here. So imbalance always varies depending on the time frame. So right here, we can see we had imbalance from this candle to this candle, but then price came back down and filled it here. So currently we have no imbalance here. We have imbalance from here to here, but then price came back down and partially filled it. So imbalance left would be this. Now we have imbalance from here to here, but then price came back down. So this is the current imbalance left behind. And yeah, I guess you guys got the hang of it now. It's very simple. You can use imbalance as an area for direction where price could go, or a reason for price to go. So for example, in this situation, this is NAS, so it's kind of different. But in Forex, it's much more simple because it doesn't massively go in one direction, whereas that NAS does. But we could get a good idea for a pullback. So we could say pending order down here, target the high, stop loss down here. Reasoning, there's all this imbalance here, and this is at the previous pullback zone. So it makes sense for price to come down, refill these imbalance zones, trigger a C, and continue on with trend. So yeah, you can use these in a lot of different ways, and hopefully this did help.